Welcome to the Mid-Penn Bank Podcast, hosted by President and CEO Rory Retrieve. In this episode, Rory is joined by Mid-Penn Bank's Regional President, Natalie Falatek. Here's the conversation.
All right, so this is your first time on the podcast, right?
Correct.
You've been an employee for how long?
Almost 15 years.
15 years. And we've had, how long have we been doing the podcast, Scott? Is it 2 years?
Yes.
We're quite at 2 years?
We're at 2 years.
Yeah. So 2 years. So you weren't invited in before this, even though you've been an employee for 15 years. But the good news is you get to evaluate our brand new theme song. You want to play it, Scott?
Here we go.
Pretty jazzy.
Yeah, I like it.
Jazzy, little upbeat. Was that done by our friend Ethan?
It is. So we can give him some feedback and he'll give us a nice polished version.
I don't know. I like it.
I like it too.
I think we're good.
All right. I'll let him know.
All right. So, Natalie, when you started with the bank 15 years ago, which was about a year after I got here, you were first up in Elizabethville, right?
I was.
So what did you do prior to coming to Mid-Penn?
A little bit of everything. My degree's in hospitality.
Mm-hmm. From Penn State.
Yeah, from
Right.
Penn State.
I think we were talking about that last week at the Connections class, that we have a lot of people who have hospitality, tourism type of degrees, a lot of which came from Penn State, a couple, I think, from Temple, but I think that must be a really good degree for banking.
It is. I think the customer service aspects of it translate well. And when I was in the degree, even I always said my passion was managing people and processes. Mm-hmm. So certainly something I do every day here.
Doing, yeah. even back as the manager of the financial center in Elizabethville, which that's what we call them now. The people and processes that was key for that too.
Absolutely.
And you came into that situation, not to badmouth anyone that was here prior to you, but that branch at the time was a little bit of a mess. How long did you feel it took you until you felt you had it under control?
Well, the interesting thing was I was only in the branch, their financial center there for about 6 months before Scott approached me about coming over to commercial lending.
Right.
So, I think I was probably, a good 6 to 8 weeks until I kind of got my legs under me. Mm-hmm. But after that, it came together really well. The staff was great. They were receptive to change. It was kind of a change overall, not just within the financial center, but the bank was going through a time of change.
Right.
So they were receptive to it, and it made it a smooth transition.
So did Scott, that was completely unsolicited for him to come to you, or had you shown some, interest in lending? So
I spend a good amount of time with Bank of America in mm-hmm. their recovery and risk operations area, which was largely credit-based. So I had a strong credit background.
Recovering risk. What is that? Is that like,
is
that what like Bonnie does?
Yeah.
Okay.
And I was unsecured card collections and supported the unsecured card division. So, but it was everything from a charged off credit card to a charged off checking account to an estate account. Going through the estate process or people in debt management plans. So I had a really strong credit background. And he approached me one day and said, "Have you ever thought of being in commercial lending?" And I said, "No." Because it wasn't something that had ever, crossed my mind at that point in time. But it actually was a great fit because it was serving Upper Dauphin County and mm-hmm. the entire, small business community of Upper Dauphin County, which was where my heart was.
So that was the original position. It was a small business lender specifically for Upper Dauphin County.
Yep. Our current lender was retiring or had a planned retirement, and we were looking for someone to service that area as a commercial loan officer.
And did you also have some branch responsibilities at that time, or?
I didn't when I first took over, but about 6 months later, I took over the Millersburg Financial Center as well.
Yeah.
Was doing a dual role there for a while.
And how long did you do those two things together?
Probably about 2.5 years mm-hmm. Until I became our SBA lender in 2014.
So you started in 2010.
2011.
2011. And so now we're at 2014.
Yep.
So half year at the branch, 2.5 years as on the SB or the small business / Millersburg.
Yep.
So it's sometime in 2014, and now we come to you with a harebrained idea of getting us further into SBA lending.
Correct.
And when we first did that, give me a sense of how did we accomplish that? Because you don't just wake up and say, now we're SBA lenders. And I do believe that the bank had a preferred lending status prior to my time here.
We did.
But we kind of rejuvenated that at or around 2014. So tell me about how did we accomplish that?
Yeah. So, I think a strong partnership with our Philadelphia SBA office,
Mm-hmm.
and a strong partnership with NAGLE, the National Association of Government Guaranteed Lenders. I did their diploma certification program, but really it was just going to everybody and anybody and said, "How can I learn this quickly?"
Did we start with using a vendor?
We did. We used
Holtmeyer and Munson.
Yep.
Was that, yeah.
Yeah, a third party. They call them lender service providers.
Mm-hmm.
And they were helping us to process our applications through. I think that first year we did 3 small business loan applications and 3 small business
more than
loans.
we did the year before.
Yeah. And, worked with Holtmeyer Munson and really learning their process, everything end to end from, how you package a loan, how you navigate it through the SBA approval process, and, participation on the secondary market.
And again, you didn't have any specific SBA experience prior to that, right?
I didn't.
So that's what we love to do here, Scott. We take someone with no experience at all and make them get the experience in something like SBA, which is pretty complicated business.
Yeah, it is. I think that first year I traveled to a lot of training classes. I think I did more than 60 classroom hours in the classroom.
And was that all NAGLE stuff or?
It was largely NAGLE.
NAGLE being the National Association of Government Guaranteed Lenders?
Yes, that's correct.
Surprised I got that.
But yeah, largely, with NAGLE and taking their classes, also working directly with the SBA in their Philadelphia office and going to almost every training that they offered and that they put out there as well.
And learning a little bit from Holtmeyer and Munson kind of on the job. So when did you start to do that certification program?
I took my first class for that certification in the fall of 2014.
2014. And how long did that take you?
It took me about 1.5 years to do the basic certification. After that, I did go on to do the advanced certification, and that one took me about 3 years to complete.
So that was 2018-ish that you got that?
Yeah, 2018, 2019. I think it might have been until I took the test and got it back.
And when you got that, so this is now a big certification from NAGLE, which again is the National Association of Government Guaranteed Lenders, and you picked that up in 2019. How many other people in the country had that at that time? At
that time, it was less than 50.
Less than 50 people. So you were in pretty rarefied air.
Yeah, it was uncharted territory.
Yeah. And as time went on from 2014 through 2019, we were having pretty decent success as an SBA lender throughout our footprint was a lot smaller then, but we were having pretty decent success.
Yeah, during that time, we reestablished ourselves as a top 10 lender within the Philadelphia district.
Right, so that Philadelphia district would include every bank kind of in central Pennsylvania through eastern Pennsylvania, right?
Yeah, that's correct. A lot of big SBA lenders,
Mm-hmm.
Wells Fargo, PNC.
A lot of big banks,
yeah.
A lot of big SBA lenders.
Yeah.
and we were regularly ending up in the top 10.
Yes.
So that's all pretty good. And then we get into 2020, and what happened then?
PPP.
Right. So during the COVID shutdowns, and when the federal government developed the CARES Act, which had the Paycheck Protection Program as part of it, And that was signed by the president, I believe, on March 27th, which was a Friday. And it was signed at 4 o'clock. Now, we had been looking at it, and we knew that they were talking about some type of program that would help businesses keep their employees employed, even though they weren't, a lot of them were not working because they were sent home during the 15 days to smooth the curve or whatever it was called. So we found out once that CARES Act was signed that the program was going to be administered through the SBA.
Correct.
Right? So we had a meeting the next morning. So this would have been March 28th, I think at 8 o'clock in the morning. So this is when, again, most of our employees were working from home at the time, and we all came in, and I remember looking at you and saying, so when are they going to have the application for this? And you said, I don't know. It probably won't be until sometime next week. And going back to that time period, they said how much they were going to do of this. And we all were thinking, boy, that's going to go fast, right? Because I think, was the original amount like $300 billion?
It might have been. It was much lower.
Yeah. I think it was $300 billion. And that just didn't seem like a lot if every company in the country was going to be eligible for it. And so we were, moving in that meeting with a little bit of a sense of urgency. And I said to you, well, look, you're an expert in SBA. You know what they're going to want in that application. So could you build an application by tomorrow and have it, maybe you ask for a little bit more than what the SBA ultimately is going to want, and you accepted that challenge. So you put together an application that I believe we had online by Sunday afternoon.
I think we did.
Right. And so by the time the SBA actually did come up with its application, which I think was the next Wednesday, I think it was the middle of the week, and they were saying that they were going to turn the system on by Friday. So a week after the CARES Act was signed, which I believe was April 3rd. And by the time they did that, by the time they put out their application, we had already had
several hundred
applications. And a lot of them were coming from other areas of the country, right?
Yes.
So it was a really unique time period. And we could have never done that without your expertise.
Thank you.
And we ended up doing, was it $400 million that first round?
The very first round, yes.
Yeah. And ultimately, between the two rounds, we ended up doing over $1 billion of PPP loans, which, based upon the size of bank we were at the time, put us in the top 1%, I think, of lenders in the country. And then even better, we were better at the forgiveness portion than we were at the origination, which I think we had all of our loans substantially forgiven by the beginning of 2023.
Yeah, we did very well in forgiveness.
So that time period, even though we were excelling and we were doing the videos, which I think, I still get complimented on today from complete strangers. As I go around our footprint, people tell me about how important those videos were to them. But during that time period when the SBA is administering, I don't know how many billions they did of PPP, but it had to be pretty close to $1 trillion.
It was.
Yeah. So, but what about all the other traditional SBA loans? The 7A, the 504, were they just paused at that time?
No, they continued. And actually 2020 and 2021 were very high volume SBA years for Mid-Penn Bank.
Not including the PPP.
Not including the PPP. Yeah. I think, our the most volume of applications that we ever did was kind of in that September 2020 to September 2021 timeframe. PPP was great, and the COVID EIDL loans that they did were great, but people still needed traditional lending and SBA lending.
Particularly as the country started to, get back in action and employees started to come back to work and the vaccines were available. I'm sure that did stimulate a lot of.
It did. And the other thing that really stimulated, people reinvented themselves during that time. So they were changing direction, needed a new piece of equipment to be able to manufacture something, locally that was previously purchased abroad or whatever it is. They reinvented their business to make it work in the new world.
So 2020 and 2021 are really good years for the SBA overall, and specifically at Mid-Penn. And then what? So 2022, what started to happen at the back end of that year to suppress demand?
I think there started to be a lot of chatter about program integrity.
Was that related to the PPP or just overall?
Overall, yeah. I think it was kind of on everybody's radar, through COVID, EIDL, and the PPP loans, maintaining program integrity, portfolio quality, started to get a lot of chatter, and how we underwrite as SBA lenders kind of came into focus, and the administration at that time really wanted to take some of the fast processing, high volume processing abilities of COVID EIDL and the PPP loans and put them into 7A lending. And so we saw major policy changes in that time frame.
So did the interest rate increases in the back half of 2022, though, did they have an impact on
certainly
SBA volume?
Yeah, certainly they did. Most SBA loan rates at that point in time were double digits. 10 to 12% was probably the average SBA loan.
Because that's the thing with the SBA loans. They're not cheap. They're not inexpensive. They're, the interest rate's a little bit higher than what a traditional, or maybe not a little bit higher, significantly higher. But it's because it's a, lender of last resort type of environment, right?
Yeah. And, what I think a lot of people, the way that the SBA loan program is funded is through fees that are generated at the time that, you make the loan application. And then every month, in most cases, the lender takes a portion of the interest rate they collect and sends it back to the SBA to continue to fund those defaults. It's a zero subsidy program,
right.
Meaning that, paying the loan defaults is coming from the fees that they're generating off of the program.
So going back to PPP, there were a lot of people complaining about that there was, widespread fraud. Did they ever figure out how much fraud there was? If they originated $1 trillion of PPP loans, like how much did they publish those numbers?
So they didn't publish those numbers. There were a lot of numbers published and a lot of, hypotheses and guesses about what it actually ended up being. But they never published the number and said, this is what it netted out to, or, when they did the investigations. It was a really interesting time. One of the stories that comes out of PPP is the fact that the lenders reporting on themselves and on their own loans and on their own portfolios and borrowers actually decreased the FBI's average tip to conviction rate.
Oh, really?
Yeah, across the entire term, because the lenders were giving such detailed information and, borrowers were admitting to it, and it significantly brought that down. They recovered a lot of dollars through that program as well.
So do you think that the black eyes that kind of got during during 2022, 2023, did that impact any other SBA programs and the way that they originate and evaluate loans?
Yeah, certainly. We saw after that, we saw what the SBA called their risk mitigation framework that they put into place on all 7A loans and 504 loans, where they started to run, when you're applying for a regular 7A loan, through the government's do not pay lists, through other databases, and started to create algorithms to try to determine if there was fraud that was happening in the 7A portfolio as well.
So let's talk about the 7A. That's the core product, correct?
Correct.
Yeah. We'll talk about 504. I know we don't tend to do a lot of 504 loans, but from a 7A standpoint, what did it look like prior to COVID, and what does it look like today? Like, what differences are there?
So, one of the biggest things from a borrower impact is the fee structure. Prior to COVID, we had not charged upfront guarantee fees on small loans under $350,000, probably since 2015. It had been a number of years where we had those fee waivers in place, and we're able to offer our borrowers fee waivers. So, the upfront guarantee fee was one. The underwriting process significantly changed. Now we have a new SOP as of June 1st, and it's going back. So what we're seeing now within the 7A world is a trend back to underwriting standards, portfolio administration, to the way that it was in 2020 and in 2021.
So more rigorous?
Yeah, more rigorous.
Yeah.
It was late 2023, when they announced the SOP, what the SBA called the do what you do rules, which allowed banks for small loans under $500,000 to defer to their internal credit policy when making decisions. Now, for MidPenn Bank, we have a strong credit policy. We pride ourselves on being, prudent underwriters and, make good risk decisions. But that's not the case for every bank. So, right. We saw in 2024, 7A loans being approved without a write-up, without a credit memorandum. They called it score and go.
Scott, just so not here. She's
not here. But, now they've rolled all that back and they're transitioning back. Well, we never significantly changed what we were doing. So this is an easy transition for us in this policy.
So the 7A program today, who's it ideal for?
So the 7A program is an ideal fit for a lot of borrowers. I think I have a we love sheet that I use when I'm talking to the financial centers and helping them to kind of scout for these opportunities. We love service-based businesses. Sometimes they struggle with, tangible collateral. We love, I say we love mom and pops. We love the second generation that is coming in and taking over ownership in what was a family business, generational businesses. And can the second generation use a 7A loan to pay off the first gen? Absolutely. Yeah. That's a great product. We love professionals, dentists, doctors, high dollar equipment that they have to purchase that can be difficult on a 3 or a 5 year conventional bank loan. We love owner occupied real estate. It's great for someone, and I think we saw a lot of this, more of it post COVID and post in the new world, where landlords are selling the building. And we have a business that's been in there for a very long time. Maybe they don't have the down payment money that they need to, purchase it, but they don't want to move or risk having a new landlord that they're not familiar with. So we can help with those transitions as well.
And the underwriting criteria, in your opinion, your learned opinion, is do you kind of break your underwriting standards because it's an SBA guaranteed loan, or do we use it as a credit enhancement?
MidPenn Bank, we use it as a credit enhancement. We don't, we follow prudent underwriting, and prudent's a word that you hear a lot with the SBA, but prudent underwriting, prudent lending standards, regardless of what type of loan it is. I think it was Scott Mickelwright who, when I was first transitioning into SBA lending, said, remember, the SBA guarantee never makes a good deal or a bad deal good.
Right.
But it takes that one that, is kind of hanging on the fence and pushes it over to the other side.
Yeah, and not hanging on the fence from a credit standpoint, just hanging on the fence from an overall standpoint. Like if you've got a couple coming to you to start a business and they've got experience, in working in that type of business, but maybe not in owning that type of business. And they've got some meaningful equity, but maybe not quite enough. And otherwise their credit's good. Like that's credit
Absolutely.
enhancement, right?
Yep.
It's the type of thing where they have the experience, they have the know-how, they have some resources, maybe just not enough.
Yeah. One thing that I talk a lot when I'm working with financial centers or commercial loan officers about what an SBA guarantee can fix and what it can't. And I always start off with, it can never fix cash flow.
Right.
It has to be a business that can afford to make the payments and afford to pay back the debt. And then I usually end with, and it can only fix one thing. We can't fix, we can have a collateral shortfall and no down payment and we need a longer term, but one of those we can overcome with an SBA guarantee.
So the cash flow, yeah, you can, like that's it's fundamental of every loan. You got to have the cash flow to pay it back. If you don't, there's no way to put a guarantee on it and make it better. How about from a guarantee standpoint? We love to have guarantors on our loans. If there's a couple that's saying, well, we have the expertise, we almost have enough equity, but we don't want to guarantee the loan.
It's a pass.
It's a pass.
Yeah, that's SBA. I mean, that's bank.
That's an absolute requirement in SBA, right?
Yeah, absolutely. They require personal guarantors. Sometimes if there's a small minority owner, they might not be required to guarantee. But, your principals, key employees even can be required to provide a guarantee on an SBA loan.
How about geography? So we, as a community bank, we try to lend in our backyard. Sometimes we get requests to do loans that are from a borrower in our backyard, but maybe the project's not in our backyard. Would an SBA guarantee make sense in that instance?
Yeah, depending upon the project that it is, it could make sense. There can be challenges where it doesn't make sense to have something that's located too far away from us, whether it be because of monitoring or, possible, forward-thinking collection activity or something like that. It might not always make sense, but there can be times where it makes sense.
Right. So what do you think the future of the SBA 7A program is? Like now with this new SOP that came out June 1st, do you think that it'll stimulate activity this year, or will it be benign, or will it suppress?
So I don't know that the SOP is going to suppress. I think that there are some lenders, fintech lenders, those that really reduced their underwriting criteria when we were under the old do what you do, more lax underwriting criteria, that they're going to have to do some work in order to, come on board and implement the new SOP and get their arms around what that looks like and what that means. My biggest concern for suppressing loan volume is the fees that are associated with it. All of the fee waivers went away. The ongoing servicing fee was instituted to the statutory maximum, and I'm worried that that's going to price some borrowers out of the program.
So, what was the high watermark for SBA 7A loans in volume for a year? Was it 2020 or 2021?
Yeah, probably 2021, I would say. We were just under $30 billion at that time. Our cap was $30 billion.
For the whole country?
For the whole country.
And what do you know what the number was in 2022, 23, and 24?
I don't know if it was mid-20s.
Okay, so
Yeah, we
down
were not
from the peak. And what do you project, or do they do projections every year? Do they say we hope to get this much this year?
Well, we do our what we're approved for in the budget and what our allocation is, and I think that we're at $30 billion again for this year. I think that the feeling is that will be more than enough for the year.
Because maybe the demand's just not quite what it was back in 2021?
Yeah, I think that's fair to say.
I mean, I think that we're seeing that pretty much throughout our broad commercial pipeline. Not that there's no pipeline. It's just not as strong as it was at this time last year or in any previous years.
Yeah,
right?
absolutely.
Kind of hearing that. And I think that's a lot to do with the concerns on the tariffs and concerns about the economy and, concerns about the wars and all that, right?
Yeah.
So how often do you communicate with the SBA?
So, with our district office, anytime that I have a concern, they're right there. Regular updates, probably quarterly. We have our quarterly connect calls with the SBA, which is they transmit information, to industry professionals a lot through that. At least monthly, I'm involved with NAGLE and, their meetings and their calls, and they're involved with the SBA on a daily basis.
So, and NAGLE is not part of the SBA.
NAGLE's not part.
Right.
NAGLE's actually our trade organization.
Yeah.
And, liaison with the SBA.
Right. And do they have any type of formal relationship with the SBA? Does the SBA use NAGLE as a consultant, or is it just two totally separate organizations?
They're two totally separate organizations. They certainly work in partnership together. There's an arm of NAGLE that's a lobbying arm, and that does lobbying on behalf of lenders in, DC for SBA related issues. But they, when we have a NAGLE conference, which I go to annually, the SBA is there speaking. The SBA is hosting sessions, and giving out information. So they have a really strong relationship with the SBA.
And do they publish loss rates, the SBA?
Yeah, the SBA
so if
does.
they're originating $20 to $30 billion of SBA guarantees a year, what are the loss rates on that?
So right now, I believe it's less than 1.76.
Really?
So I want to say 1.76 was
That's pretty good.
what they were predicting. Yeah. The dollar amount is a little bit harder to get your the math for.
Yeah, but that's fair. If it's 1.76,
yeah,
I mean that's higher than what a bank would want, but these are,
they're high risk loans.
They're higher risk loans.
Yeah,
no doubt. So what about the SBA 504 loan? So how does that differ from the 7A?
So the 504 loan is a fixed asset acquisition program, meaning, a 7A loan can be used for working capital. It can be used for a variety of things. With a 504 loan, you're either purchasing real estate or equipment, or you're refinancing the purchase of real estate or equipment. It's a little bit different where, as in the 7A loan, the bank holds the entire note, and the SBA typically only becomes involved if there's a default and we need to collect on it. On a 504 loan, you're going to have a conventional bank loan. Then you're going to have a 504 loan from a community development company partner on it. And then you have your borrower equity injection.
And what are those percentages?
So typically, in most cases, it's 50% for your bank loan, 40% for your CDC loan, and then 10% for your equity injection.
And that CDC loan is guaranteed by the SBA?
Correct.
Okay.
Yeah.
So the bank loan's not?
Correct.
But the bank gets a first lien on the asset?
Correct.
So if there's $1 million project, $1 million purchase of a building, the bank would lend $500,000.
Yep.
The CDC would lend $400,000 guaranteed by the SBA, and they'd have a second lien on the property, and then the borrower would put in 10.
Correct.
10%.
Yep. I mean, there are times when put in a little bit more.
Yeah.
But generally, that's the way it works.
And what are the loss rates on those loans? I would suspect that they're going to be less because there's collateral.
Yeah, and there's fixed assets. I apologize. I don't know that one off the top of my head. It's a little bit harder to nail down because the first loan, those are privately held at banks.
Mm-hmm.
And so it's a little bit more difficult to research those.
And what do you think is the prototypical SBA 504 borrower? Obviously, someone who may not have more than 10% to put into it, right?
Yeah.
But is it more than that, though? Is it because the bank, at a 50% loan to value, that seems like a pretty easy deal to approve, as long as you have a borrower who's otherwise creditworthy, right?
Yeah. It's primarily the reduced equity injection. 504 loans also, right, the interest rates on them are really that second 40% piece. You can get a low 25-year fixed rate.
So that's the other benefit.
Yeah, that's it, and that's a transferable
so
note.
Who sets that rate?
That's set by CDC market rate in the SBA. So that fluctuates just like a home mortgage rate.
Right.
It changes daily.
So just on average, like if we were doing an SBA 504 loan, and we're going to do that 50%, and let's say we price it at 7% fixed for 5 years, and then it adjusts, what would their loan look like? About just.
I would probably right now, assuming it's on real estate, it would probably be somewhere in the 6s.
And fixed for how long?
For 25 years.
Yeah.
Yeah, I mean.
So that's a real benefit.
Yeah, and I'll tell you, before the interest rate changes, 2021, 2022, some of those were fixed at 3.5%, under 4% for 25 years on a transferable note.
Right. And if they did one of those 5 years ago or 10 years ago, they're loving it.
Yeah.
Right? Because even with interest rates going up, that doesn't change.
Yep. Yeah, that stays consistent.
So how much has that program done over the past few years? Was 2020, 2021, was it a high water mark for that also, or?
Yeah, it was a high water mark for the 504 program. It's significantly less. I think typically about a third of where the 7A program is. I really thought that was around the time where they released the 25-year debenture. And I really thought that with that 25-year debenture, it was going to we were going to see the tides turn and it was going to flip, and the 504 program was going to, upshoot the 7A program. It didn't happen that way. There was a boost to it, but the ratios kind of remained about the same.
What are the ratios from an origination standpoint? Is it like 3-to-1 or 4-to-1 or?
Yeah, I think it's about 7A is probably about 3-to-1.
Really?
Yeah.
Wow.
Now you have to remember on the 7A side, you're financing the whole thing is included in that number, and on the 504 side, only 40%.
Right.
Sometimes less is included in that number.
It seems to me that a lot more people gravitate to a 7A and don't even know about a 504. Is that just my opinion, or is that real?
No, I think that's typical. There are some banks that like the 7A product, they don't even offer 504 loans.
Right.
And then there are some banks that don't dabble in the 7A side, but they'll take lead on a 504 project as well. I think 7A tends to be easier for banks and for the borrower to get through. And that might be why they go over to the 7A side. The 504 also tends to be for your larger dollar amounts. We've always done a really good job of having a low average 7A loan size, keeping it at or about that $500,000 mark. But really when 504 starts to become more advantageous is when you get up over $1 million to $2 million.
So how good are we at the SBA 7A process? So if someone came in today and assuming they have, after you give them a list of what you need, they respond to it on a timely basis. How long from start to finish for us?
I mean, if there's no real estate involved in the transaction, we can easily do that in 30 days.
Nice. And that's through documentation settlement.
Yeah, that's through documentation and settlement, and again, part of that is because we do now package in-house now. We do the paperwork ourselves. We're a preferred lender. So it's not a matter of we're doing all of our underwriting and then, we stop and send it into the SBA.
Right.
So a lot of those underwriting pieces that take more time, like your search, we can run that concurrently with some of the underwriting stuff that we're doing.
And the preferred lender status basically means we approve our deals.
Correct.
Yeah, we're not submitting them to SBA for, an additional approval.
Correct.
And do they test that? Like, or is that preferred status given to you and it's just good forever? Or do they look at your own loss rates?
So we have
and see if you're making good decisions.
The SBA audits us every 2 years,
Mm-hmm.
and they pull loan files. They review. I usually write about a 10-page narrative to them when they do it, but they look at our loan files. They look at our loss rates. They analyze a whole host of information that comes from our portfolio. And they do that every 2 years. And then, they are constantly monitoring, they call it our Paris rating, but it's a scoring metric. I'm looking at that quarterly. They're looking at it quarterly to really analyze how our portfolio is performing. And then they compare it to our peer group as well.
And do they share those numbers with us?
Yes.
So how do we generally compare to our peer group?
So we are typically outperforming our peer group on a lot of numbers like delinquency, average in versus average, they can tell you exactly how much through our loan fees and our, giving back over the last 5 years, how much we've paid in and how much we've taken back for defaulted loans. And so in that way, we're doing fantastic compared to our peer group because we have paid in a surplus. I think when I last looked, it was like over the last 5 years, we've contributed, positive $500,000 to the program.
Wow. And does the SBA generally make money?
We think so. It's kind of
because there's not a lot of government programs that actually make money.
Yeah. So as a whole, does the SBA as an institution make money? No, because it's so much bigger than the loan program.
Right.
And one of the things that has, with the new administration changes, we were under fee waivers for this year, and they came back and said that we were predicted to be requiring a subsidy. We were going to have to take taxpayer dollars to pay our defaults this year. And so that's why they went to the statutory maximum on fees that they could institute. But that math isn't shared.
That's not.
It can be very difficult. Nagel has gone on our behalf several times and said, hey, OMB, can you tell us how you're getting, how you get that math, how you get those numbers? And I get it's a complicated process, but I think we could use some more transparency there.
So do they get allocated tax dollars every year in advance, or is it wait until the end of the year, see what the losses were like, and then figure out if you need tax dollars?
They calculate it ahead and they're required to set the fees so that it comes out to zero.
Right.
So that's what they're doing. They told us with the program increases, they believe that we would be back to zero. And so if it is planned or predicted based upon the algorithms that we're going to need taxpayer dollars, they'll request that in the budget.
And does SBA and CRA, the Community Reinvestment Act, do they tend to, does SBA support CRA lending, or is it just not anything related?
No, they do. Actually, one of the things that we were really excited about was last year, all 504 loans are now CRA eligible.
Really?
And we've been pushing for the same thing to happen for 7A loans. And that's a change that we'd like to see, that all 7A loans are CRA eligible.
What's the theory that you do that lobbying under? Is it because most 7A loans end up in disadvantaged communities, or?
I think it's the fact that the SBA is it's run through the Office of Capital Access. So the whole basis of the program is to make capital available to underserved, businesses who couldn't otherwise get traditional financing. So it's an underserved market, by basis of the fact that they're in the they're in the SBA program and have a guarantee on them.
And do credit unions, are they able to make SBA loans?
Some of them could. They could certainly participate in the 504 program. I am not familiar with any credit unions that have preferred lender status or have their preferred. There are mission-based lenders. Community Advantage lenders was what we used to call them. Mm-hmm. It was a Community Advantage pilot program, which were mission-based lenders that could do really small loan amounts. One that we have here is Community First Fund, is a mission-based 7A lender. But
his organization, right?
Yeah. So.
Yeah, well, the credit unions are such already a drag on the tax dollars, so no sense in making them more. All right, so how's the family?
Good.
Yeah?
Very good.
How old's your son now?
He is 16.
16. So is he driving?
Yes, he has a driver's license.
But is he driving?
Yes, he's driving. He does really well. My daughter is 15, and I'm a little bit more worried about when she starts to drive.
I can't believe she's 15.
Yeah.
That's crazy.
Yeah.
And is he thinking about what's he want to do when he gets out of high school?
He has been tossing around a number of ideas and things that he wants to do. He's definitely someone who wants to work with his hands. He's doing landscaping this summer.
Nice. That's good.
Yeah. So he's looking at some different trade programs. He's been looking at, Pentec, probably some sort of trade or technical program is what he'll look into.
You look at the starting salaries for some of the kids coming out of trade schools, and they're like unbelievable.
Yeah.
And they're not going to spend an arm and a leg trying to get a degree. So that's good.
So
does he take more after you or more after Cal?
I think that he has a little bit of both of us in him. He probably takes after me a little bit more.
Yeah. How about your daughter?
I have no idea where she came from. No, there are certain things. She looks exactly like me. But I think she probably has more of his personality.
Well, Natalie, listen, you've had a wonderful career here. It doesn't honestly seem like it's been 15 years, but I know it has been. And you did a great job in Elizabethville, and you did a great job in Millersburg, and you did a great job as a small business lender, and you've done a great job administering the SBA program, and you've done a great job as the regional president of our Upper Dauphin County region, which is our legacy market. And you have done a great job in the PPP, and this organization certainly owes you a debt of gratitude for all the things you've done.
I appreciate it.
And if you're considering doing a loan that you think would match up with the SBA 7A program or the 504 program, I couldn't encourage you more to work with qualified lenders. Whether that means that they have the preferred lender status or just that they have a lot of experience doing this. Because the SBA program, the process can be a nightmare if done by the wrong people, right?
Yeah, I can feel like you get stuck in a loop sometimes.
Yeah, and you hear about those stories, and it took 6 months to get a look from start to finish. And sometimes that's because the borrower isn't, giving you what they're supposed to give you, but sometimes that's because the bank's not guiding them on what to give and when to give it and how to give it. So I think that if you're out there and you're considering an SBA loan, I'm not, you got to come to Mid-Penn Bank. You got to talk to any one of our lenders who will consult with Natalie and figure out if an SBA loan is right for you. And, the SBA has been around for a long time. How many years?
1976.
1976. So that's, my math is correct. That's 50 some years, or just about 50 years.
Double check when the loan program was, but
yeah. So they've been making a positive difference for, and I hate calling them small businesses. I always like to say owner managed businesses. They've been making a difference for owner managed businesses forever, and we're proud of our association with the SBA and under your direction. So thank you for all that.
Thank you.
All right, Scott, I think that's about it for today. Who do we have coming up next?
We have Jen Pensinger coming up next.
Oh, from Pennsylvania Breast Cancer Coalition.
Yes.
Great. So that'll be a fantastic one. And on the advent, or coming up on our golf tournament in July, which raises money for Pennsylvania Breast Cancer Coalition and Penn Medicine down in Philadelphia, their Bosser Center. And this year we're also going to give a little bit of money to Cooper Health, because over in New Jersey, they also have a breast cancer research center. And so we're going to spread the love a little bit, but it'll be great to have Jen in here. And Natalie, thank you so much for coming in today and sharing some thoughts.
Thank you.
About the SBA.
Great to be here.
All right, everyone, have a great day.
Thank you for listening to the Mid-Penn Bank podcast. You can find more episodes at Apple Podcast, Spotify, Amazon, and more. Do you have a question about the podcast? Email us at podcast@midpennbank.com. References in this podcast to Mid-Penn are to Mid-Penn Bancorp, Inc. and its subsidiaries and affiliates. This podcast expresses the views of its participants and may not represent the views of Mid-Penn or its officers and employees. In addition, these views are subject to change without notice, and Mid-Penn has no duty or obligation to update the information contained in this podcast. This podcast is being made available for informational purposes only and should not be used for any other purposes. You are encouraged to consult with competent legal, tax, accounting, or investment professionals before engaging in any financial transaction. Mid-Penn does not make any warranties as to the accuracy or completeness of the information in this podcast, does not endorse any third-party companies, products, or services, and assumes no liability for your use of this information. Forward-looking statements should not be considered guarantees or predictions of future events. This podcast is the sole property of Mid-Penn and may not be copied, reproduced, republished, or posted in whole or in part in any form without prior written consent of Mid-Penn.